Welcome to Shark Cap Table LITE. Make a deal and keep your arms and legs. We're going to talk about one round of equity and royalty financing. Now, let's look at a few things that we have here. You can hide the help by just simply clicking on this, or you can show the help. I prefer to hide the help at first. Keeps the right-hand side of the model clean. You can call the investors sharks or investors or VCs. I kind of like sharks. It's more humorous, but don't leave it in there forever because you'll print sharks when you try to send out your executive summary, and that might not go over well. If it says good choice, sell shares, works in LITE, that's good. If you see anything else, follow the instructions. For example, I'm going to move this up here. These are the default settings. Read these. The key issue is that when you have LITE working, it communicates with FAST, and FAST needs to show sell shares, show the shark, and hide all help. Now let's go scroll over to the left again, and let's actually get a deal going. The fast way to do it is to simply dial in the number of dollars that the founders will have put in. Let's say 15,000. Now, this is a good number. It depends on historical actuals. So let's put in some actuals. Let's put $1,000 in. And let's do a million shares. Let's put $9,000 in. Let's put oopsie, that's a little too much. Let's put 9 million shares in. And let's do 5,000 shares with a little different number. How about 3 million shares? Okay. Now, I'm going to zero this back down because we've got our $15,000 into the company. Now, let's go on down and let's read what we have here. We actually probably want to put in some options. So let's put $500 and 100,000 shares. Another $500, another 100,000 shares. Okay, so along the yellow line here, you have the total shares and pre-money options. This is the average price per share based upon the amount of dollars put in. It won't be the same when these guys finally exercise. But for now, we've got $16,000 invested in the company for a total of 3.2 million shares outstanding. Scroll down a little bit and continue. Number 2 is the option pool. Professional investors like to see an option pool. It's a way of rewarding future managers with a significant portion of your company. It dilutes you, but not the investors. So let's put in 15%. We should have a nominal positive cost of, let's say, $500. If it gets to be too small, that you will end up with giant internal rates of return, and it looks kind of silly. Detailed founder valuation. Well, here we go. Here is, I'm going to scroll down a little bit so we can refer back and forth. Here's the founder share investment. There's your 15. We do not have the investors or the founders investing any more cash. That might come in a little bit here. So here we have from the red sheet, the detailed founder valuation. Now there's that $15,000 that the founders put in, and the rest of this are items that you can enter. For example, maybe you have $10,000 worth of beta tests or revenue and proprietary idea, patents, whatever. The yellow is blank. When you put a number in it, it stops being yellow. You cannot change these, but anything in blue you can change. Now, sometimes you may see a number in here, and it may be coming from FAST because FAST has a quick way of estimating. We're not connected right now to FAST data. We're going to put in brand new data. So that's where this 485 came from, detailed founder valuation plus the 15, and there's the 500,000. Now, we need to have a shark pre-money value, so let's say the sharks don't believe your 500 and only give you 300,000, and the shark cash investment is, we are looking for $300,000. So there's $300,000 right there. Now, let's go down and see what's going on here. We need to do something else. We need to put in a sale price of maybe $2 million. And we think we're going to get that sale price in year 4. So we can scroll through using this. And notice that the exit value is fixed so that when you scroll through the multiple changes, as you get larger, and by the way, we already entered these for you. You could put in any number you wanted to, but these are your revenue projections. So let's come back and put this at year 4. 2 million is 2 times the current year's revenues, or 1 time next year revenue. So you might say we could get a little bit more, so let's go to 2.5, and that happens to be 2.5 times. Now, if the Sharks got 50% of the deal, which is based upon these numbers up here, they would get $1.25 million, or 50% of the total. So one of the problems we have here in structuring this deal is here's our 300, there's the shares issued, price per share, there's the $300,000, exit in year 4. Shark share gets 50%, but right here is 50% ownership based on a 42% internal rate of return and 4 times the multiple. I'd like to not see you give up or lose control, so one of the things we might do is we might scroll back up here and we might say, look, we need to get some more money in from the founders. So maybe they hit up on some of their friends and family and they bring in another $35,000. There. Now you can see what happens. We're asking for more money, and the way they do it is they do this. And basically the founders are buying the shares. And what will happen is that these guys have a specific ratio of ownership, and they're going to buy this ownership or this offering based upon that ownership. I'm going to scroll quickly down to show you that that is taken care of in section G, the summary of the founder shares, pre-money options, which includes more cash invested. And right here you can see that we've increased the dollars because if you add those up, they got 50. You know that we put 35,000 more on it. So that's how it's apportioned. It does not affect pre-money options. They're the same, 500, 500, and 100,000. So let's go back up here. Now, if we put another $35,000 in, it's conceivable that we might be able to convince the Sharks to go a little higher. Remember, we said we had 535, of which 50,000 of that is cash. Maybe we could get them to go up a little bit, maybe to 400,000. That will help our position. Let's go down and see what our position now looks like. Well, here we got 42 and 37% and 3.56. That's a good starting point. I'd still like to see something better. What I want to do now is I want to remember what we've done by marking them. Drop these things down in the light yellow gray, click on the number, and these will remain static so that we can do some further adjustments. We could do that by offering, through a combination deal, a royalty. And let's do a preferential royalty, which simply says let's give the guy 3 times whatever his target is. So we've just dialed in 3. The target is going to be whatever you want it. Maybe $60,000 is a good number. And then we're going to spin in the preferential royalty from whence these numbers will come. In other words, you have to have a royalty to pay out a royalty. So give them a 5% royalty, and the total is the preferential revenue, which is, of course, 3 times the $60,000 coming out of a 5% royalty. All right, now let's see what has happened. If we gave them that, their internal, their I multiple would go up to 4.16 from 3.56. Their internal rate of return would be 43 as opposed to 37. And they still own the same ownership. So I would be inclined to try to give them their 34.4 by increasing. And I can do it over here to get the fast one, and then I can fine tune it right here to get it right down to 374. And there we have it. So by offering a 5% royalty, they get an extra $180,000. You add that extra $180,000 to the Shark share, which is now 34.8, and the total is now a little over $1 million. They still maintain a pretty good internal rate of return, so on the multiple, but this is the important one, the 37.4, and their ownership has dropped from 42 to 34. Not so bad. Maybe that's a deal we can do. Now, if you get stuck and you can't remember how all this works, go back up here and go up and ask for the help. Show help. And you'll see there's a lot of interesting things going on, and especially right here. This tells you how to do it. Another thing is that we take all these numbers and we concatenate into a nice paragraph which can be cut and pasted into Microsoft Word. You can further edit it or embellish it, and you can use it in your business plan or your pitch deck. Now here's the long-awaited capitalization table, and here we have the 4 components plus the totals, with the total investment, the shares issued, the share price, the post money, the exit value, and if there was a royalty, it would be reflective of that, and of course the internal rates of return. Now we have already been to section G, where we've discussed the founder shares after they've bought more shares, pre-money option again. Now we come down to a very powerful section, which is the pitch maker. This is section H. This is where we create sentences and we put them all into a concatenated statement. For example, we've given you 4 go-bys, 4 examples. Example of product and service. So you write the same sort of thing, use the same type of punctuation and capitalization. Do that for each one of these. You'll break the equal sign, don't worry about it, because we leave it in there the first time so that you can see what's going on. After that, yours is going to look like this. And of course, we're going to take all of yours and stick it into that, and now you have a shark pitch for 2 founders. What I neglected to show you is that you have to put the name of your company. If you have 1 founder, just put that founder's name in the first box. If you have 2 founders. The other thing is that we have to have some kind of an investment goal. Here we're saying that we have a revenue goal of $2 million, which is the projected revenues in year 5, and really we want to make it more like when we're selling. So these 2 numbers should be the same. The exit year is 4, so we want to keep these in concert. Hence we got green. Now if we go up to 5, it goes to pink. If we go to 4, when this is 5, it's yellow, and so forth. So let's keep it both at 4, because that's the exit year that we had planned on. Now let's do one more thing. Let's go up here. We did set the preferential royalty for year 2. Now we can see something very interesting. This is why you use preferential royalties. Okay, so we've set it up, and there's our preferential royalty, and there's the $180,000. So what happens is there's the 5% of $250, there's the 5% of $500,000, and since we're selling in this year, we have to make up the difference because we're supposed to give them $180,000. So this plus this minus 180 is $142,500. Now watch what happens. This is really cool. If we go ahead and sell in year 5, notice that this is still the same, but notice that the amount of money is getting less. If we click one more time and sell in year 6, guess what? We are no longer burdened by the preferential royalties. They've gotten their money, which is 180, starting year 2, 3, 4, 5. By that time, they're done. Look what happens if we happen to sell this company for a whopping $10 million out here, which is 2.5 times the current revenues. No longer do the preferentials share, and it's just the shark share, which now is down to 34.8 as opposed to 50% when we first got started. Then it went to 40% when we started jiggering a little bit, and now we're down to 34.8, and everybody is happy. So don't forget to use preferential royalties. They are far better than regular royalties, which, by the way, would be continuing throughout. Now, the last thing that this does is we create an executive summary. And you have to write the opportunity, but the rest of this is just automatically drawn in from the prior sheet. I suggest you go to the detailed founder valuation. Scroll to the bottom and you will see 11 important questions. Answer those and discuss them, and you should put the answers basically in here and you'll be good to go.